If you have ever opened a forex trade and you notice that you are slightly in the red the moment it opens, that's not a glitch. That's the spread doing its job. So whether you are scalping or you are holding a trade for some days, spread is one of those silent profit killers that can eat into your returns if you do not understand how it works. In simple terms, spread is the hidden cost of trading. It is not deducted like a visible fee, but it is always there whether you lose or win. Understanding how spread work is key to becoming a smart and efficient trader because it helps you avoid overpaying on trades, choose better brokers, time your entry more precisely, and ultimately keep more of your profits. So in this video, we are going to break down what spread really means, how it works, what affects it, and how you can use it to your advantage. So let's get started. First, what is spread in very simple terms? In forex trading, spread is the difference between the buy price, that is the ask price, and the sell price, that is the bid price of a currency pair. Think of it like this. Let's say you are at a currency exchange booth and they say, we buy dollars at $1,480 and we sell at $1,500. That $20 difference is their profit, and in forex that is called the spread. On trading platforms, the spread is usually displayed as a few pips. In the forex market, the tighter the spread, that's the smaller the spread, the better for you as a trader. And the wider the spread, that's if the spread is larger, the more you pay when you open the trade. So you want to aim for tighter spread. Here's a quick example. Imagine you are trading Euro USD and the broker shows the bid price as 1.1050 and the ask price as 1.1052. The spread there is 2 pips. If you were to open a buy trade, you would enter at 1.1052, and if you immediately closed it, it would be sold at 1.1050, meaning you start off with a 2 pip loss. That sounds simple, right? But there's more to it, especially when you factor in the fact that there are different types of spread. So let's quickly see the types of spread. There are 2 types of spread, and that's the fixed spread and the variable spread. Let's begin with the fixed spread. A fixed spread stays the same no matter what is happening in the market. For example, if your broker offers a 2 pip fixed spread on Euro USD, it means that no matter what happens while your trade is open, the spread will remain the same. So even if there's a release of a news event or there's high volatility, the spread stays the same. Let's see an example. Let's say your broker shows a bid price of 1.1050 and an ask price of 1.1052. That's a 2 pip spread and it won't change even if there's a major economic announcement. The benefit of trading with fixed spread is that it is easier to predict, it is more suitable for beginners because it's easier for them to understand, and it makes it easier for you to set up automated strategies. But of course, everything that has a good side also has its bad side. And for fixed spread, one of the major downsides is that it is usually higher even when the market is calm when compared to variable spread. So in a calm market, a broker that offers a fixed spread may have like higher spread when you compare it to a broker that offers variable spread even when the market is calm. I hope that makes sense. Now let's go on to see the other type of spread. That's the variable spread or the floating spread. As the name implies, a variable spread changes depending on the current market condition. For brokers that offer variable spread, when the market is calm, you may notice that the spread is tight. For example, 0.8 pip. But during major news releases or when the market spikes, you may notice that the spread can become wider dramatically. It can go higher up to 5 pip or even more. Let's see an example. During a calm period, a broker that offers variable spread may have a bid price of 1.1050 and an ask price of 1.1050.8. Now this gives us a spread of 0.8 pip. But during high volatility, like say the US releases the non-farm payrolls, you may see a bid price of 1.1045 5 and an ask price of 1.1051, and that's a spread of 6 pip. You can obviously see the dramatic change from 0.8 pip to 6 pip. Now you see that that's a lot. And you should note that when a broker is offering variable spread, the spread can change even when your trade is open. So you may go into the trade with a tighter spread and something happens and the spread just changes and it can hit your stop loss or just affect your entire trade. For the pros, variable spread are tighter during calm markets, so they are cheaper to trade, and they are often offered by ECN brokers. And for the cons, variable spread can spike unexpectedly, and it is riskier if you are trading around news events. Now you may be asking which one is better, but it all just depends on your strategy. If you are somebody who really values stability, then you can go for fixed spread. But if you are somebody that wants to trade at a cheaper cost and you are able to handle volatility, then you can go for variable spread. So it just depends on you and your strategy. Let's move on to see how spread is measured. So I'm going to be taking time now to explain what pip means, just in case all the while I've been saying 0.8 pip, 6 pip, you've not properly understood. This is the time to understand. Let's see how spread is measured. Now, to really understand how spread works, you need to know what pip means. A pip stands for percentage in points or price interest points. It is the smallest price movement that a currency pair can make, usually 0.0001 for most pairs. So what this means, for example, let's say Euro USD moves from 1.1050 to 1.1051. It has moved 1 pip. Note that it has moved 1 pip because pip is measured in 4 decimal places. So 0.0001 is equal to 1 pip. I hope that's simple enough for you to understand. However, you may want to keep in mind that some brokers quote prices in up to 5 decimal places. In that case, the last digit is called a pipette, which is 1/10 of a pip. So 1 pip equals 0.0001 and 1 pipette equals 0.00001. So now that we understand what pip is and how it is measured, let's go on to see why it matters in spread. Let's say your broker quotes the bid price as 1.1050 and the ask price as 1.1052, and we know that the spread is the difference between the bid price and the ask price. So the spread in this case is 0.0002, and that is 2 pip. Remember our calculation of pip. Now, even though this looks like a very small number, because 0.0002 is a very small number, but in forex trading, it can affect your trade. Now, let me explain this. If you are trading one standard lot, which is 100 units, a 2 pip spread equals $20. So yes, even a tiny spread matters, especially if you are somebody who trades often and you trade large lot sizes. And of course, if you also trade small sizes, even the tiniest spread matters, so you want to pay attention to it. Now that you know how spread is measured, let's talk about what causes spread to change or widen. Now, we've seen that there are different types of spread. There's the fixed and the variable spread. And the fixed spread remains the same. So once you open your trade with a 2 pip spread that is fixed, for example, it stays the same and it does not change. But a variable spread can change while your trade is open. But now, aside that, you may notice that even brokers that offer fixed or variable spread, irrespective, their spread is not always the same. So you can come in now and you notice that there's a tight spread of 0.5 pip. And 1 hour later, you notice that even though it's a fixed spread, it has changed to say 5 pip. So what causes the spread to change? Because if you can understand this, you may be able to also understand the best times to trade for you, depending on what is happening in the market. Now, the first thing is volatility, market volatility. And this is when the market is moving fast. The market is usually more volatile when there is a major news release. Let's say there's an increase in interest rate, or the US non-farm payrolls was released. You may notice that spread widens, and that's because liquidity providers get nervous, and because they are nervous, you may notice that they are widening the spread to protect themselves from price swings. Now, let me give an example. During the US interest rate announcement, the normal spread for Euro USD might be 1 pip. But the moment it is announced, it can jump to 5 pip or 10 pip. And if you're a day trader or a scalper, this can mess up your trade entries and exits big time. So knowing this, you want to be on the lookout for activities that can cause increased volatility in the market, because when there's increased volatility, there are chances of spread widening. Now, the next thing that can cause spread to widen is volatility levels. Volatility means the volume or the level of buying or selling that's happening in the market. The more traders in the market, the tighter the spread. So high liquidity equals tighter spread, and low liquidity equals wider spread. For example, during the London or the New York session, there is usually higher liquidity, and as such, you may notice tighter spread. But after the close of the New York market, you may notice that there are wider spread, and that's because there are less active traders in the market at the time. Now, the next factor that can cause spread to be wider or tighter is the type of broker. The broker you use affects your trade. For example, market makers may offer fixed spread, but they may mark them up. And then ECN or STP brokers may offer variable spread that are tighter, but then, as we know, variable spread fluctuates and it's unpredictable. But you should also note that some ENT brokers offer raw spread as low as 0.0 pip. However, such brokers usually charge commission separately, and commission is yet another fee that you may have to trade as a forex trader. So you want to choose between tight spread plus commission, or higher spread and maybe little or no commission. Another factor that can determine whether you are trading with tight spread or wide spread is the currency pair that you are trading. Not all currency pairs have the same spread. You may notice that major currency pairs like Euro USD or USD JPY have tighter spread, and this is because they are heavily traded. So many people are trading it, and as such, there's more liquidity for those currency pairs. And remember, the higher the liquidity, the tighter the spread. Exotic pairs, on the other hand, like USD, ZAR, may have wider spread, sometimes 10 pips more. And this is because there's less liquidity on those pairs and more risks. Now, another factor that can determine whether your spread is tight or wider is the account type you are trading with. Now, you may have noticed that brokers offer different types of accounts, and for each account type, they offer different spread and trading conditions. For example, you may notice that a broker offers a standard account and a raw spread account, and the raw spread account may offer very tight spread. However, it comes with a commission per lot. Now that you know what causes spread to change, let's apply everything that we've talked about in this video into a real-world example so you can see for yourself how spread can affect your trade. Let's say you are trading Euro USD and your broker shows a bid price of 1.1050 and an ask price of 1.1051. That's a spread of 1 pip. You decide to buy one standard lot, which is 100,000 units. Now, if you do not understand what lot means, or you are struggling with how to choose your lot size as a forex trader, you may want to see our video on how to choose or how to calculate lot size in forex trading. A link will be in the description. However, it's on this channel. You can just check it out. Since the moment you open a buy trade, you enter at an ask price that's 1.1051, but your trade is already valued at the bid price 1.1050. You are immediately 1 pip down. With a standard lot, 1 pip is equal to $10. So you are starting with $10 loss purely because of spread. So I hope you understand this. This means that the market needs to move 1 pip in your favor before you break even. Let's see another example with GBP JPY with 3 pip. GBP JPY is a more volatile currency pair, and that's why I'm also using it as an example. So let's say that your broker shows you a bid price of 183.50 and an ask price of 183.53. So that's a spread of 3 pips. If you enter a sell trade with 0.5 standard lot, here's what happens. 1 pip of GBP JPY with 0.5 lot is approximately $5. So 3 pips is equal to $15. With $15 cost, the moment you hit sell, even if the price does not move at all, you are already down by $15. So I hope you see why your spread matters a lot. The wider the spread, the more you need the markets to go in your favor for you to break even. So the more time it takes for you to break even and start making profits. I hope that makes sense to you. Now let's also see an example of spread spiking during the news, so you understand how variable spread can affect your trade. So you are about to trade USD CAD during the US job report. Right before the news, the spread is tight. So you have a bid price of 1.3700 and an ask price of 1.3701. So this means you have a spread of 1 pip. But the news drops and the spread jumps to 1.3690 for the bid price and the ask price of 1.3705, and that's a spread of 15 pip. So if you were not watching the news and you entered a trade at that moment, you could start off with $150 loss on a standard lot just because the spread widened. So you see why it is very important for you to watch the news and be very particular about your spread, because you need to break even before you can even make profits. Now I know you should already be seeing a picture of how spread can affect your profits or your loss, but let's talk about it even more. From everything that we have discussed so far, you have seen that because of spread, you are always starting a trade with a small loss. Whether you are buying or selling, you are starting in the red. Now this is clearly because you enter as the ask price if you are buying and the bid price if you are selling, and the market needs to move past your spread before you even start to make profits, as we have seen in all the examples so far. But let's also see an example. So let's say you buy Euro USD at 1.1052 and you have a bid price of 1.1050. So that's a spread of 2 pip. Now until the bid price rises to at least 1.1052, you are still in a negative territory. Another thing you want to keep in mind is that your spread adds up over time. So now here's an example to help you understand how your spread is adding up over time. Let's say you trade 5 times a day with a 2 pip spread on each trade using a standard lot. Now 2 pip times $10, that's equal to $20 per trade. Note that we are using Euro USD for example. So 5 trades equals $100 per day. In a month, 20 trading days, that's $2,000 spent on spread alone. And even if you're a smaller trader, let's say you're using 0.1 lot, 2 pip equals $2. 5 trades equals $10 a day. And in a month, that's 20 days of trading. You have spent $200 on spread alone. Now, this is why high frequency traders are very picky with spread, because they understand how their spread adds up and they are spending money on it. It is just one hidden cost that is taking a lot of your money. So you too should be picky, be very particular about your spread. Now, here's another reason why you should be particular about your spread. And that reason is that your spread can flip a profitable trade into a loss. So even a trade that was moving in your direction can end up being just a break-even trade. You did not make any profit, at the same time you did not lose, or can even end up becoming a loss, especially if you had a small target, you closed the trade early, or price did not move far enough beyond your entry. So with that said, here's something I also want you to keep in mind. When choosing your stop loss and your take profit, you want to consider your spread in mind. If you place your stop loss or your take profit too tight, the spread might hit it before the market even gets the chance to move in your favor or against you. So you want to be very particular and consider your spread when determining your take profit or your stop loss. Let's also see an example. So you set a 5 pip stop loss on a buy trade with a 3 pip spread. Now the bid price only drops 2 pip, but because the ask price is 3 pip higher, your stop loss hits, even though the market didn't really move against you far. Just before this video ends, let's also see between low spread or commission, which may be better. At some point as a forex trader, you will have to make this decision. Do you go for a tight spread account with commission or a zero commission account with wider spread? So let's also discuss that. So the first option, zero commission account with wide spread. This is what many standard accounts offer. They have no commission at all, but the spread is marked up, is higher. Let's see an example. Let's say you trade Euro USD and your spread is 2 pip and the lot size, that's one standard lot, no extra fee, so no commission. 1 pip equals $10, so 2 pip spread means you pay $20 to enter the trade. That's your hidden cost. So you were not charged any commission, but because of your spread, you have a fee of $20 if we are going by this example. Now let's see option 2, that's raw spread plus commission. Such accounts give you actual market spread, which can be as low as 0.1 pip. However, they charge commission per lot, which is typically around $6 to $7 per round trip. That's both entry and exit. Let's see an example for this. So let's say you are trading Euro USD and your spread is 0.2 pip and you have a lot size of one standard lot and a total commission of $7. So let's do the cost breakdown. The spread is equal to $2, the commission is equal to $7, and total is $9. So you actually save $11 compared to the standard account example that we gave before now. So especially if you are trading larger lot size or you are scalping. So now this brings us to the question, which is better? And I do not know if this is the answer you were looking to hear, but it all depends on your strategy. Scalpers or high frequency traders usually go for raw spread plus commission accounts because of course the cost is lower over time if you look at it. On the other hand, casual or low volume traders usually go for zero commission standard accounts. This is because it is easier to manage even if you pay a bit more per trade. Here's something that is worth noting. During periods of high volatility, raw spread accounts usually give tighter pricing, even though there are market spikes. So you want to keep that in mind. So the bottom line is that you should not just look out for accounts that probably does not charge commission. No, you want to calculate the overall cost of trade before entering a trade or before choosing an account. You want to calculate the spread plus the commission and then decide which one saves you more money over time. Finally, let's see how to choose a broker with a good spread. Choosing the right broker should not just be about their flashy advertisement or how easy it is to sign up. No, if you are serious about trading, then the spread they offer should be a very important factor that you consider before choosing any broker. So here's how to choose a broker that will not silently drain you of your profit because of the bad spread they offer. First, you want to compare their spread tables. Do not just guess. Most brokers publish a spread list or a contract spec on their website. Look specifically at pairs you trade, often like say Euro USD, GBP USD. Just look out for the Just look out for the pairs that you trade and, be careful, watch out for their spread. Now, here's a tip. If a broker is offering Euro USD with an average spread of above 2 pip, that's high for today's standard. Top tier brokers offer 0.0 to 1 pip spread for major currency pairs. The next thing you want to look out for is who is regulating that broker. Is that broker properly regulated? Regulation matters, especially in countries where the governments have set up proper bodies to regulate Forex brokers. For example, if you are trading from the UK, you want to be sure that the broker is regulated by the FCA. If you are trading in South Africa, you want to be sure that the broker is regulated by the FSCA. So just do proper research, see which broker is regulated by the regulatory body of your country. Now, unfortunately, in some countries, especially around West Africa, Forex trading is not properly regulated. So you want to be on the lookout for where your account is regulated under, which regulatory body governs your own account, and see what their rules and their regulations are, because those are the rules that will also govern your account. I hope that makes sense. Now, the reason why regulation is important is because regulated brokers are usually more transparent about their spread, and they are less likely to practice like all these shady stuffs like widening spread just out of the blues for no reason. Now, the next thing is that while, yes, we've said that brokers usually have a spread table on their websites, while that, yes, is a good thing, you also want to look at their real-time spread. So you can probably open a demo account and look at the real-time spread, because what is on the website may not be updated, but what you have on the trading platform, even if it's a demo account, is real-time spread, and that's where you get like real information. Now, lastly, on choosing a broker that offers good spread, is that you want to ask other traders and not just Google. So yes, while it's easy to Google best Forex broker with low spread, yes, you can also hear from other traders, and an easy way to do that is to join Forex trading communities. And for example, since we're talking about this, we have a free Forex trading tool for you where you can interact with other Forex traders real time and hear what they have to say. You'll be surprised how helpful their inputs can also be. And to join our free Forex trading community, just visit mytradingland.com. It is absolutely free, and you can get insights from other traders, which you may find helpful. So finally, spread is one of the overlooked fees in Forex trading, and that's because it's not very visible. You don't just see $20 spread, but it is there, and it's a hidden cost. And once you understand it, you have gained an edge, because it will guide you on choosing the currency pair to trade. It will guide you on when to enter a trade, how to place your stop loss, how to take profit. So spread and understanding it is very important. Think of it like this. If you cannot control the market, you can control when and how you enter the market. And understanding spread is a smart way to do it. So I hope this video has been of help to you when it comes to understanding how spread works. And I hope that these are things that you can practice to make better informed decision. If you have found this video helpful, don't forget to give it a thumbs up, and of course subscribe to this channel, because we have many more videos in store for you to help you, build a proper trading strategy and understand Forex trading properly, because our goal is to see that you understand Forex trading properly and that you don't fall into the hands of scammers. So yes, thank you, and I'll see you in the next video. Bye bye. Don't forget to subscribe.